Welcome to Talk Tickers. Today we're going to break down the Q1 earnings for Richardson Electronics, that's ticker RELL. This report really sent some shockwaves through the pre-market, so let's just dive right into what caused all the commotion.
So what happened? Well, the market's reaction was, immediate and pretty powerful. The stock just surged over 15% in pre-market trading. And that is a massive move, especially for a company that had kind of been lagging for the past year.
So, what caused this explosion? It was a colossal beat on both the top and the bottom lines. I mean, look at this. Earnings per share came in at 13 cents. The consensus estimate was just 2 cents. They absolutely demolished it. And revenue? Same story. $54.6 million, handily beating the $51.5 million expectation. This wasn't just a beat, it was a real statement. So, how in the world did they pull this off? A headline beat is one thing, but the real story here is always a little more nuanced. Let's peel back the layers and see what's really going on. So if you look at the individual segments, you see some solid, if not spectacular, growth in their power and microwave technologies, that's PMT, and their Canvys display divisions. But that negative 10% in green energy solutions, or GES, that immediately raises a red flag, right? How can a company post such a strong beat when one of its key growth segments is apparently shrinking? And this is where it gets really interesting. You have to look past that headline number. The explanation from management tells the whole story. That entire decline was because they were comparing this quarter to a massive one-time EV locomotive order from last year. So if you back that out, the core green energy business was actually up. It's a classic case of a tough comparison masking the underlying strength. And it doesn't stop there. There's another key adjustment to make. If we exclude the healthcare business they sold off back in January, the core company's growth actually looks even stronger, coming in at 6.8%. See, this really shows you that the headline number was hiding some real momentum in the business right now.
And this slide right here, this tells the real story behind that earnings beat: margin expansion. Gross margin ticked up to 31%, all driven by a much richer product mix. The star of the show, no question, was the semiconductor wafer fab business. It surged over 52% year over year. You take that high margin revenue, combine it with cost discipline, and boom, EBITDA nearly doubles to $3.3 million. That is some powerful operating leverage.
So a great quarter is one thing, but the big question is, can they keep it up? Let's take a look at management's playbook and the catalysts they're seeing on the horizon. Okay, here's the game plan for fiscal 26. The most important near-term thing to watch is the final approval for their GE Ultra 3000s. That's a key ultracapacitor product for their green energy segment, and it's expected this quarter. In that high-margin semi-fab business, they expect the current run rate to hold steady for the first half and then accelerate in the back half of the year. Oh, and despite that tough Q1 comparison, they're still guiding for double-digit growth in green energy for the full year. And you know what underpins this whole growth plan? A rock-solid, fortress-like balance sheet. They're sitting on a really healthy backlog of over $134 million. They've got nearly $36 million in cash and zero drawn on their credit line, which, by the way, they just extended out to 2028. To top it off, confirming that 6-cent quarterly dividend just signals how confident management is in their ability to generate cash. All right, let's bring it all together. We've seen the strong quarter. We've seen the positive outlook. So after a 15% pop, what's the call on the stock from here? Yeah, this is the million-dollar question for anyone looking at RELL today, isn't it? Was this just a one-time pop, or is this the beginning of a real sustained re-rating for the stock? Our verdict is an outperform rating. We believe this margin expansion story, which is being driven by that semi-fab mix, is sustainable. It provides a much higher floor for their profitability going forward. Now, while the stock might consolidate its recent gains here in the short term, we predict it's going to retest its highs as soon as we get confirmation of that GE Ultra 3000's approval. That catalyst really de-risks a key part of their growth story and should bring a lot of new investor interest to the table. And that wraps up our Talk Tickers analysis of Richardson Electronics Q1 earnings. As always, this is not financial advice.